maximum fund under IRS guidelines. In this episode, we are going to address the question, how can universal life insurance be used for living benefits? This is episode 2 of a series of 21 titled Secrets to a Tax-Free Retirement. If you immerse yourself in this education, you're going to be blown away. I'm going to show you how you can accumulate an extra $1 million that will generate $100,000 a year of tax-free retirement income into perpetuity. So my name's Doug Andrew, and I've been doing this for more than 45 years. Doing what? Helping people optimize their financial assets, minimize taxes, and empower their authentic wealth. But I've been deemed primarily a retirement planning specialist. My favorite vehicle I call the Laser Fund, which is a max-funded, tax-advantaged, indexed universal life insurance policy. I own several. My kids all own several. We've had thousands of people use this incredible tool to provide tax-free income for their retirement that knocks the socks off of IRAs and 401ks. So how did it all come about so that it was designed to be used for living benefits? E.F. Hutton, who was not an insurance company, they were a brokerage firm in America like Merrill Lynch and so forth. And clear back in 1980, they were trying to help their clients with stocks and bonds and mutual funds. I mean, I started in the financial services industry back in 1974. And I had a Series 1 securities license that allowed me to sell stocks, bonds, mutual funds, everything. They don't even offer that Series 1 license today. You have to have a Series 6, Series 7, Series 63, 24, all these different ones that equaled what that one was. And so from 1974 until 1980, I ended up being responsible for over 3,000 clients in 13 Western states. And I was trying to do my best to help them put their money into the market in different diversified mutual funds. I was a huge proponent of buy term insurance and invest the difference. Because if you invested the difference, even though you would have to pay tax on what you earned in the mutual fund sooner or later, even if it was an IRA, I could show people how that would outperform a whole life insurance policy that only at that time was crediting 3.5%, 4% interest. So E.F. Hutton said, why don't we buy term and invest the difference for our clients under a tax-free umbrella in sections of the Internal Revenue Code that have been around for decades? The 3 sections were 72E, 7702, and 101A, which I'll address in another episode. But let me share with you the idea that E.F. Hutton had to use life insurance for living tax-free accumulation and tax-free income, not just for the tax-free transfer when you die. So E.F. Hutton realized, golly, if we had our clients' money in the market, subject to volatility, it was like playing red light, green light when I was a kid. Sometimes you may take 20 steps forward. You might make 20% in a really good banner year. But then you had to take 10 steps back when the market corrected or there was a little recession. So you go up and back, up and back. Because I've often described the stock market as like a person with a yo-yo, hopefully walking up some stairs. So E.F. Hutton said, you know what? We are trying so hard that between up and down, averaging 12%. I mean, that was our goal, if we could average 12%. And they realized, well, even if we could do that, and yet most people were not, because most people buy and sell at the wrong times. They get worried when the market drops down 20 or 30% and they sell, and then they wait till the market comes clear back up here and then they buy. And so most investors in the market do not average 9 or 12% that they could if they just bought and held. The actual return is about 3.5% according to Dalbar. Isn't that pretty pathetic? But E.F. Hutton said, even if we could time the market and achieve 12%. So instead of taking 12 steps forward, okay, on the average, they realized, well, wait a minute, whether money has to be taxed as they earn it, or whether it's tax deferred and at the end of the day, you have to pay tax when you retire and take it out, like an IRA or 401k, you're not netting 12. You're taking 12 steps forward, okay, but you're having to take 4 steps back in taxes. Because most Americans end up with about a third of their money going out the window in taxes in retirement. So 12 steps forward, 4 steps back in taxes, only netting 8. Another step back for fees, because most asset managers charge about 1% in fees. So if you made 12%, you're only netting 7. In other words, if you had $1 million nest egg and you're earning 12%, that's $120,000. That's not all your money. See, only $80,000 of it is your money, and then you have to pay another 1% in fees. That's another 10 grand. You're only netting $70,000 out of the $120,000, 12% rate of return, to buy gas and groceries, prescriptions, and golf green fees. And so E.F. Hutton basically said, instead of having to take 12 steps forward and 4 or 5 steps back, why don't we just take 11 steps forward and 1 step back? What were they talking about? Back in 1980, interest rates were high. Now, interest rates are relative. When interest rates are high for earning, they're high for borrowing. I mean, mortgages on homes were at 18 to 21%. CDs at banks were paying 10%. Can you believe that? But back then, most insurance companies' general account portfolios, which I explained in another episode, they were earning between 11.75% to 15.5% on AAA and AA bonds and mortgages on shopping malls and skyscrapers and so forth. And so I never earned less than 11.75% from 1980 to 1990 on my universal life insurance policies. So let's say we're earning 11. I'll just come down to 11. They were saying, let's take 11 steps forward and only 1 step back. What's that step? It's not tax. See, insurance is tax-free. That 1% is the cost of the insurance that the IRS says has to be there. This must be defined as an insurance policy in order for it to be tax-free. If it's not, then it is under another section of the Internal Revenue Code, and that's a taxable investment subject to volatility. E.F. Hutton said, hey, let's take away the volatility and let's earn an average of 11, netting 10%. That 1%, when you think about it, is money that would otherwise go out the window in unnecessary taxes. If you had an IRA or 401k or a regular mutual fund, you'd have to be earning 15%, pay tax of 1/3 to net 10. I only have to earn 11 to net 10 in the universal life, and that is a safer bet. So that was the brainchild of E.F. Hutton. In order to make it perform to where only one of those percentage points was the cost of the insurance, Hutton said, hey, under Section 101A of the Internal Revenue Code, we can simply put in a large lump sum of money and we are self-insuring. It's tax-free. So if you put in $100,000 or $500,000 or $1 million, the objective is to take the least amount of insurance the IRS requires and put in the most premium the IRS allows as fast as they allow, and it turns into a tax-free cash cow. This is how you can earn 11 and net 10. So what does that mean? Back in 1980, when I saw this, I thought, whoa. This is buy term and invest the difference on steroids. In other words, I had people put in $500,000. They're earning 11 and netting 10. What's a net of 10% cash on $500,000? 50 grand a year, 10%. They put in $500,000 and we're pulling out $50,000 a year of tax-free income for years. They're still doing it. Now, isn't that incredible? But what happened is the IRS came in and said, what are you doing, Hutton? And they took him to court and they passed some tax laws that I'll explain here in a couple of episodes. But the beauty behind this was to use universal life primarily for living benefits. Can you still use it for death benefit and pay lower premiums than most whole life insurance policies? Absolutely. Whole life insurance was forced to be more competitive. Whole life is okay for death benefit, but whole life insurance doesn't hold a candle to universal life when it comes to creating predictable income streams that are tax-free. I can earn 11 and net 10, which I've done for the last 25 years. Whole life insurance, if it credited you 8, you'd be lucky to net 5.9 by the time you're 95 years old. And so that's why I like universal life, because E.F. Hutton designed it for living benefits. The death benefit also comes along for the ride. So back then in 1980, the objective, I called it the backdoor approach. Instead of people coming to me wanting to buy as much insurance as they felt like they wanted or needed for the least premium, people came to me and they would tell me how much money they wanted to set aside for their future, for their retirement, to have tax-free growth and tax-free income. So this was the brainchild again, where E.F. Hutton said, wow, money inside of an insurance contract accumulates tax-free. You can access the money tax-free for living retirement income benefits, and it's totally tax-free. And when you ultimately die, it blossoms, it increases in value and transfers income tax-free. Nothing else does that in the Internal Revenue Code. Municipal bonds don't do that. A Roth IRA doesn't blossom when you die. So this became the most incredible tool, and I've been using it for thousands of people since 1980. What you have to do is comply with the IRS guidelines that I'll explain in the next episode so that you can accumulate, access, and transfer your money tax-free. But you determine what is called the guideline single premium. You don't have to pay a single premium, but you want to reposition assets from other places that are non-performing, or they're in a volatile situation in the market, and you want to have more liquidity, safety, and predictable rates of return. You may end up wanting to reposition $200,000 out of this property that you sold, and $200,000 out of IRAs or 401ks, $100,000 out of CDs or money markets only earning 1%. That's a total of $500,000. That's the amount. That's the guideline single premium. And then the IRS dictates what's the minimum amount of insurance that must be attached so that your $500,000 will grow like crazy income tax-free. If this is resonating with you, I would encourage you to watch the rest of the episodes in this 21 video series, Secrets to a Tax-Free Retirement. The next one is what I recommend. But if you want to cut to the chase and read a book that we have written, this is my 11th book. It's called The Laser Fund, and it has over 300 pages containing charts, graphs, explanations. You flip the book over and you have 62 actual client stories. I'll tell you what, I'll buy the book. It's free to you. You just go to laserfund.com and you pay a nominal $5.95 shipping and handling. I'll fire the book out to you. You'll have options to get the audio version, the digital version, however you like to learn. Also, we have an 18-hour masterclass, but I encourage you to watch this episode next so that you can connect the dots.